You'll probably hear a lot of investors brag about big wins in Toronto real estate, but is it before or after tax? Because the ones getting ahead really are the ones keeping more after tax. Now, before we go any further, let's be clear, this is not tax advice. We're not accountants. We're real estate investors and a real estate sales brokerage. What we're sharing in this video is general knowledge that every serious investor in Toronto needs to understand if you don't want to overpay with taxes. When you invest under your personal name, your income from real estate usually falls into two buckets: rental income or capital gains. Rental income is pretty straightforward. It's rent minus expenses like property tax, maintenance, insurance, and the interest portion of your mortgage. Whatever's left over gets added to your personal income and gets taxed at your marginal income tax rate. Now, capital gains only come into play when you sell, and you're only taxed on half of that amount. That taxable half is added to your income for that year. And let's run through this with an example. Say you buy a multiplex for $1 million and you spend $100,000 fixing it up. And then later on, in a few years' time, you sell for $1.5 million. Your capital gains is $300,000 after fees. Half of that is taxable. If you're in Ontario's highest tax bracket, you'd probably pay around $80,000 in tax, and you'd keep close to $220,000 after tax. Now, you can't avoid paying taxes altogether, but you can be smart about how and when you pay for this. Unlike stocks, where you generally have to sell to access your gains, real estate gives you another option: refinancing with a bigger mortgage to cash out. And when you refinance, you can pull out equity tax-free because borrowed money isn't considered gains. That's how experienced investors scale faster in the real estate space. They keep their properties, access their equity, and reinvest it without triggering a big tax bill. And just to be clear, we're not putting down stocks. They absolutely have their place. Stocks are liquid, they have low fees, and are a key part of any solid investment plan. But real estate does give you something stocks can't: control. You can decide how to improve the property, renovate it, how to finance it, which tenants you put in, how to maintain it, and when it's time to reposition or sell. That level of control really lets you actively create value and make more strategic, tax-efficient moves along the way. Now, you can also defer taxes on your rental income through depreciation, also called capital cost allowance according to the CRA, and it basically lets you write off a portion of the building value each year. You will have to pay it back when it's time to sell, but in the meantime, you do get to lower your taxable income and reinvest more of your cash flow. And basically, it's a deferral strategy, not avoidance, but it is a big deal because you're reinvesting more of the money before the CRA takes a cut, so your growth compounds much faster. Now, here's another area where investors might slip up. They don't track the small stuff. It's not just repairs and maintenance that you can deduct. If you have at least 2 investment properties, you can also expense your mileage when you're driving to manage the properties. Those little trips might not seem like much on their own, but add them up and they can really make a difference when it comes tax time. Timing might also become a difference as well. If you know your income's gonna dip, maybe you're taking some time off for a year, going on parental leave, or retiring, selling when you have a lower income year can definitely reduce your overall tax hit. And if you are investing with a spouse and one of you perhaps earns less, splitting that ownership can also help you lower your taxes as long as both of you contribute to the investment. Now, let's talk about one big misconception that I do hear as well. People might think that holding real estate in a corporation automatically means paying less tax because of the lower small business tax rate. And that is actually not true at all. Real estate is actually considered passive, not active, and so it doesn't qualify you for that small business tax rate. In fact, it's usually taxed at one of the highest income tax rates. So for most people, it's less efficient than holding properties personally, especially if you're not in the highest tax bracket. Now, with that said, a corporation still has its place. It does give you more liability protection, and you can potentially scale a lot better this way too. Now remember, this is not professional tax advice, but this is the baseline that every real estate investor should understand if you do want to grow efficiently and keep more of your returns. Now, if you do want to maximize your odds of success, definitely learn from people who actually do this themselves. And at Elevate Realty, we don't just talk about real estate investing, we do own, manage, and scale our own portfolios too, right here in Toronto. And if you are ready to grow in the multiplex space in Toronto, do it the right way with real numbers, smart financing, and solid fundamentals. We'll help you source the right opportunities, run the numbers, negotiate the deal, plan the renovations, place tenants, manage the property long-term if you want us to, so that you can focus on building your wealth instead of putting out fires. Just book a free call with us at this link here, and let's map out your next moves together.